All right, welcome to this explainer. Today, we are cracking open something seriously cool, a massive, highly structured stock market meta-analysis looking ahead to the year 2026. If you've ever felt, completely overwhelmed by the sheer volume of financial advice floating around out there, this is exactly what you need. We're going to dig into a highly curated consensus of the most recommended stocks for 2026, basically distilling hundreds of hours of content into clear, actionable data. Okay, the sheer scale of the research behind this is honestly pretty wild. The data we're analyzing today comes from a researcher who manually watched over 200 finance videos. They tracked 50 different financial experts and content creators just to cut entirely through that information overload. Imagine building a massive, messy spreadsheet tracking every single stock tip from across the internet. Well, that's exactly what was done here to figure out where the smart money is actually agreeing. Now, to even make this list, the standards were, well, they were absolutely brutal. First up, a stock needed a minimum of 4 distinct expert votes. Second, it had to be explicitly recommended as a top pick specifically for the year 2026. Third, all short-term traders were totally excluded. We're focusing on long-term positioning here. And finally, even if an expert simply held a stock in their portfolio, it didn't count unless it was a publicly stated recommendation. Basically, only the most agreed-upon stocks survived this gauntlet, leaving us with a master list of just 14 companies. Section 1. The 4 Vote Foundations. 5 stocks building the base of our consensus. So here are the 5 foundational stocks that captured exactly 4 votes each. We've got Salesforce, which we'll look at a bit closer in just a second. Then there's Shift4 Payments, a company targeting a massive $1 billion in free cash flow by 2027, making its current valuation look highly attractive. We also see Vertiv, a data center play perfectly positioned to capitalize on a total addressable market that's expected to surge to between $70 and $90 billion by 2030. Uber makes the cut because, despite all the autonomous vehicle fears out there, its core business remains incredibly brilliant and is widely viewed as absurdly cheap. And finally, Zeta, a stock that experts note is totally undervalued and currently experiencing some crazy market momentum, getting bid up even on days with zero news. Let's actually zoom in on one of the most recognizable names in this tier, Salesforce. While the broader S&P 500 ripped higher recently, Salesforce actually found itself down about 29% over the past year. In fact, experts point out it's essentially trading at 2020 levels. But here is exactly why 4 different experts agree it's a prime target for 2026. It has a massive, undeniable moat. Simply put, switching CRM providers is a painful, highly complex process for any enterprise, which means Salesforce's customer base is incredibly sticky. Expert ZipTrader pointed out something super interesting here. The era of cost discipline has finally arrived for Salesforce. They have this built-in advantage where they can monetize AI to their existing users without paying a dime to acquire new customers. When you combine that with nearly $13 billion in free cash flow, aggressive buybacks, and a historically low 5.5 times forward sales multiple, you get a literal free cash flow machine that experts believe is primed for a major rebound. Moving on to Section 2, 5 to 7 vote favorites, the mid-tier heavyweights of 2026. All right, this tier is packed with absolute giants. PayPal, Netflix, and NVIDIA all locked in exactly 5 votes. Meta stepped just ahead with 6, and leading this mid-tier with super high conviction, grabbing 7 votes each, are the South American e-commerce giant Mercado Libre and the creative software monopoly, Adobe. Let's break down the different flavors of dominance we're seeing here. For Netflix, the consensus is pretty straightforward. They have simply won the streaming game. They've reached what experts call escape velocity because of their unmatched subscriber scale. As they grow, their price per piece of content actually goes down, while the value proposition for the user goes up. It's an economic advantage no competitor can match. On the flip side, we have Magnificent 7 members NVIDIA and Meta. NVIDIA is backed because, well, it still commands the absolute lion's share of the AI market. Meta, on the other hand, was chosen by 6 experts largely because it represents the most reasonable valuation, literally boasting the lowest price-to-earnings ratio among all the Magnificent 7 stocks. Now, look at the sheer level of conviction for our 7-vote stocks. Take Mercado Libre, for example. Expert Daniel Prunk notes it has a phenomenal, long runway for future growth that is simply not reflected in today's price. The consensus view here is that if you want aggressive exposure to South America in your portfolio, this is the undisputed play. There are real expectations it could become Latin America's very first trillion-dollar business. And then, tying for the top of this mid-tier, we've got Adobe. The math here, according to experts like Arya Rodnia, is heavily skewed in the investor's favor. The core argument is that Adobe is just stupidly undervalued. Even modeling out a worst-case disaster scenario, we're talking just 4% revenue growth, they calculate you would still outperform the broader market. In a realistic scenario, they foresee a 30 to 40% compound annual growth rate, pushing Adobe close to a $1,000 stock. Which brings us to Section 3, Top 3 Consensus Picks, the undisputed champions of the data. Now, before I actually reveal these, I want you to think for a second about what might even be left. We've already taken massive names like NVIDIA, Meta, and Salesforce completely off the board. So, who actually managed to unite the most financial experts on YouTube? Let's take a look. All right, here they are. Alphabet and Sophie tied with 8 votes each, and Amazon took the absolute crown with 9 votes. It is genuinely remarkable to see a relatively smaller fintech company like SoFi standing shoulder to shoulder with monolithic tech titans like Alphabet and Amazon when it comes to expert consensus. Let's kick things off with Alphabet, sitting pretty with 8 votes. The core thesis here, championed by experts like Joseph Carlson, is that Alphabet's growth story is far from over. In fact, they argue it's maybe only a third of the way through. Despite trading at a higher PE ratio in the high 20s compared to last year, experts argue it's still not overly expensive. Why? Because when you stack the continued storylines of YouTube, the autonomous driving potential of Waymo, their Gemini AI, and Google Cloud, the general consensus is that this company is just going to keep getting bigger and bigger. Next up, we have SoFi, which also grabbed 8 votes. Experts believe SoFi is on the verge of a massive operational flywheel. The catalyst? A new Fed governor expected in May, which analysts believe will help accelerate SoFi's loan originations. Here's how the flywheel actually works. If they can sell those originated loans faster, that loan platform business spikes. That frees up capital to just dump into marketing, which attracts more users, to whom they can then upsell new financial products like crypto and options trading, toss in the hope of potential S&P 500 inclusion, and it's crystal clear why this stock has an almost cult-like following. But standing entirely alone at the peak of all this data, with 9 distinct, independent expert recommendations for 2026, is Amazon. Out of all the companies tracked in this massive project, this was the single most agreed upon place to put your capital. So why Amazon? Professor Scott Galloway highlights a fascinating operational advantage: robotics. Amazon's acquisition of Kiva Systems allowed them to deploy roughly 1 million industrial robots, compared to just 400,000 across the rest of the nation. The prediction here is staggering, honestly. Experts believe Amazon can double their retail revenue by 2032 or 2033 without having to hire a single additional employee. That kind of leverage guarantees massive margin expansion. So while it might not look conventionally cheap right now, experts agree its valuation is highly reasonable given this robotic infrastructure. Finally, Section 4, the final reveal, putting money where the math is. So out of all 14 of these consensus stocks, where did the researcher actually put their own money? They didn't go with the 9-vote Amazon, or the massive upside of Adobe, or even the cash flow machine of Salesforce. Instead, they looked closely at the entire board and hunted for the absolute cheapest valuation available. They pulled the trigger at exactly $57.20 per share. The final pick? PayPal. Now, let's be real, the researcher is completely transparent about the risks here. The economic moat is deteriorating, and the stock had recently fallen another 20%. They admit it's risky and probably not a decade-long hold. However, based on the consensus of 5 different experts and looking at major support levels on the charts, they concluded that anywhere under $60, the risk-to-reward ratio on PayPal simply became too good to pass up. Which brings us right back to you, the focused learner. We just sliced through 200 videos to find the 14 stocks the experts actually agree on, from the robotic margin expansion of Amazon to the deep value play of PayPal. So my question to you is, based on this data, which of these 14 companies is the most compelling addition for your own 2026 portfolio? Dive into the data, do your own due diligence, and I'll see you in the next explainer.